Venture capital is a form of private equity investment that focuses on providing funding to high-potential startups and early-stage companies with significant growth potential. It involves investors, known as venture capitalists, providing financial capital to these companies in exchange for an equity stake. Venture capital continues to be a vital source of funding and support for startups, driving innovation and economic growth. The relationship between venture capitalists and entrepreneurs is critical in fueling entrepreneurial ecosystems and bringing disruptive ideas to market. In addition to providing funding, venture capital firms also often offer strategic guidance, industry expertise, and networking opportunities to the startups they invest in. They may also assist with recruiting key team members, developing business plans, and preparing for future rounds of funding or even an eventual sale or IPO. Venture capital firms typically take an equity stake in the companies they invest in and may also require a seat on the board of directors or other forms of control or influence over the company's operations. Overall, venture capital plays a critical role in supporting innovation and entrepreneurship, and has helped to launch many of the most successful companies in the technology and other industries. It's important to note that venture capital funding is highly competitive and not all startups are suitable candidates. Companies seeking venture capital should have a compelling business proposition, a strong team, and a scalable model to attract investor interest. Some key points about venture capital. Investment focus. Venture capitalists typically invest in innovative and technology-driven companies operating in sectors such as software, biotechnology, healthcare, fintech, and clean energy. They seek businesses with high growth potential and a scalable business model. Risk and reward. Venture capital investments are considered high-risk investments due to the uncertain nature of startups. However, if successful, they can offer substantial returns on investment. Venture capitalists accept the risk in exchange for the potential rewards of investing in a successful and rapidly growing company. Funding stages. Venture capital funding is often provided in different stages known as rounds. These include seed funding, early-stage financing to help a company launch or develop a product, Series A, B, C, and beyond, which involve subsequent rounds of funding as the company progresses and expands. Value-added approach. Venture capitalists not only provide financial capital, but also bring industry expertise, networks, and mentorship to the companies they invest in. They often take an active role in guiding and supporting the startup's growth strategy. Exit strategies. Venture capitalists aim to exit their investments within a certain time frame to realize their returns. Common exit strategies include initial public offerings, IPOs, where the company goes public on a stock exchange, or acquisitions by larger companies. Due diligence. Venture capitalists conduct thorough due diligence. Before making an investment decision, they evaluate factors such as the company's business model, market potential, competitive landscape, management team, intellectual property, and financial projections. Limited partners. Venture capital funds are typically structured as limited partnerships. The investors who provide the capital are known as limited partners, while the venture capital firm managing the fund is the general partner. Geographic concentration. Venture capital activity is often concentrated in major startup hubs such as Silicon Valley in California, New York City, London, and Beijing. However, there has been a global expansion of venture capital activity in recent years, with emerging startup ecosystems gaining traction. Equity ownership. In exchange for the funding provided, venture capitalists typically receive an equity ownership stake in the company. This ownership allows them to share in the company's success and potential future profits. Investment size. Venture capital investments can range from a few $100,000 to several $1 million, depending on the stage of the company and its funding needs. The amount invested is determined through negotiations and valuation discussions between the startup and the venture capitalist. Investment horizon. Venture capital investments are considered long-term investments. The typical investment horizon can range from 5 to 10 years or more. Venture capitalists understand that it takes time for startups to grow, achieve profitability, and potentially generate a return on investment. Syndication. Venture capital firms often form syndicates or investment partnerships that pool their resources and share the risk of investments. Syndication allows multiple venture capital firms to collaborate and invest jointly in a startup, combining their expertise and capital. Due diligence process. The due diligence process in venture capital involves a comprehensive evaluation of a company's business, technology, market, financials, and legal aspects. This process helps venture capitalists assess the investment opportunity and identify potential risks and opportunities. Valuation. Valuing early-stage startups can be challenging due to limited financial history and uncertain future projections. Venture capitalists use various methods, such as discounted cash flow analysis, market comparables, and proprietary valuation models, to determine the value of a startup and negotiate the terms of investment. Follow-on funding. If a startup shows promising growth and meets certain milestones, venture capitalists may provide additional funding in subsequent funding rounds, known as follow-on funding. This helps the company continue its growth trajectory and secure capital for further expansion. The subsequent investments demonstrate the venture capitalists' ongoing faith in the startup's potential. Impact on innovation. Venture capital plays a crucial role in fostering innovation by providing financial resources and expertise to early-stage companies. It supports the development of disruptive technologies, fuels entrepreneurial activity, and drives economic growth. Risks and failures. Venture capital investing carries inherent risks, and not all investments succeed. Startups face challenges and uncertainties, and the failure rate can be high. Venture capitalists mitigate risks through diversification, thorough analysis, and active portfolio management. Industry relationships. Venture capital firms often have extensive networks and connections within specific industries. These relationships can provide startups with access to strategic partners, potential customers, industry experts, and valuable business opportunities. Exit options. Venture capitalists typically seek an exit from their investments to realize their returns. Common exit options include selling their equity stake to strategic buyers, private equity firms, or through mergers and acquisitions. Another exit route is through secondary offerings, where shares are sold to public investors in the stock market. Bridge financing. In some cases, startups may face a funding gap between rounds or need additional capital to reach key milestones. Venture capitalists may provide bridge financing, which is a short-term funding solution that helps the company bridge the gap until the next round of financing is secured. Investment criteria. Venture capitalists have specific investment criteria that they consider when evaluating potential investments. These criteria may include factors such as the size of the market opportunity, the strength of the team, the uniqueness of the product or technology, and the scalability of the business model. Sector specialization. Some venture capital firms specialize in investing within specific sectors or industries. This specialization allows them to develop deep expertise, industry networks, and insights, which can be valuable in identifying and supporting startups within their targeted sectors. Due diligence timelines. The due diligence process in venture capital can vary in duration depending on the complexity of the investment opportunity. It can range from a few weeks to several months, during which the venture capitalists thoroughly assess the startup's potential and assess the risks involved. Impact investing. In recent years, there has been a growing trend of impact investing within the venture capital space. Impact investors seek to generate positive social or environmental outcomes alongside financial returns. They invest in startups that address social or environmental challenges while aiming for financial success. International venture capital. While venture capital activity has historically been concentrated in certain regions, such as the United States, there has been a global expansion of venture capital ecosystems. Countries around the world are establishing their own startup hubs, attracting venture capital investments, and nurturing local innovation. Corporate venture capital. In addition to traditional venture capital firms, many large corporations have established their own venture capital arms. These corporate venture capital funds invest in startups that align with the corporation's strategic objectives and can provide synergistic benefits to both parties. Investor-startup relationship. Venture capitalists often take an active role in the companies they invest in, providing guidance, strategic advice, and mentoring to the startup's management team. This partnership helps startups leverage the experience and expertise of the venture capitalists to accelerate their growth and navigate challenges. Pro rata rights. Venture capitalists often negotiate pro rata rights as part of their investment terms. Pro rata rights allow them to maintain their ownership percentage in subsequent funding rounds by having the option to invest additional capital proportionate to their existing ownership. Board representation. In many cases, venture capitalists secure a seat on the board of directors of the startup they invest in. Board representation gives them a say in strategic decision-making, allows them to monitor the company's progress closely, and provide guidance to maximize value. Value creation. Venture capitalists not only provide funding, but also actively work with startups to create value. They assist with business development, strategic partnerships, recruitment, and introductions to potential customers or industry experts to help the startup scale and succeed. Investor relations. Venture capital firms manage relationships with their limited partners, providing regular updates on the progress and performance of the portfolio companies. This includes sharing financial reports, key metrics, and updates on any significant developments or challenges. Co-investments. Venture capital firms sometimes collaborate and co-invest in a startup alongside other venture capitalists. Co-investing allows for shared due diligence, pooled resources, and reduced risk exposure for the participating investors. Sector trends. Venture capital investments often align with emerging trends and technologies. Over time, certain sectors may experience increased investment activity due to market dynamics, technological advancements, or changes in consumer behavior. Post-investment support. Venture capitalists typically remain actively involved with their portfolio companies after the initial investment. They provide ongoing support, guidance, and mentorship to help the startup overcome challenges, refine their strategies, and achieve growth objectives. Intellectual property considerations. Venture capitalists pay close attention to the intellectual property IP of the startups they invest in, protecting and managing IP rights, such as patents, trademarks, or copyrights, is crucial for startups operating in technology-driven industries. International investments. Venture capital is not limited to domestic investments. Many venture capital firms engage in cross-border investments, funding startups in different countries to leverage global opportunities and access diverse markets and talent pools. Investor syndication benefits. Startups can benefit from syndicated investments involving multiple venture capitalists. Syndication provides access to a broader network of resources, expertise, and industry connections, and increases the chances of securing follow-on funding. Regulatory considerations. Venture capital firms operate within regulatory frameworks that vary across jurisdictions. Compliance with securities laws, reporting requirements, and investor protection regulations are crucial aspects that venture capital firms need to navigate. Industry knowledge and trends. Venture capitalists stay updated on industry trends, emerging technologies, and market dynamics. Their industry knowledge allows them to identify promising investment opportunities and provide valuable insights and guidance to startups. Venture capital continues to play a vital role in driving innovation, fostering entrepreneurship, and supporting the growth of early-stage companies. The collaboration between venture capitalists and startups creates an ecosystem where capital, expertise, and strategic guidance come together to fuel entrepreneurial success. Let's look at some examples of venture capital investments and notable companies. These examples demonstrate how venture capital funding supports the growth and success of innovative companies across a variety of sectors, drives technological progress, and shapes industries. SpaceX, founded by Elon Musk, is a private aerospace manufacturer and space transportation company. It has received substantial venture capital funding to develop advanced space technologies and launch vehicles, leading to significant advancements in the space industry. Uber, a ride-hailing and food delivery platform, secured substantial venture capital funding to expand its operations globally. The company disrupted the transportation industry and transformed how people commute and order food. Instacart, an online grocery delivery service, received venture capital funding that propelled its rapid growth and expansion. The company has become a leading player in the on-demand delivery space. Zoom, a video conferencing platform, experienced a surge in popularity and received substantial venture capital funding during the COVID-19 pandemic. It became a household name for remote work, virtual meetings, and online communication. Pinterest, a visual discovery and bookmarking platform, received venture capital investment that fueled its growth and user adoption. The platform allows users to discover and save ideas on various topics, ranging from fashion and home decor to recipes and travel. Inspiration. Stripe is a financial technology company that provides payment processing and online transaction services for businesses. Venture capital funding helped Stripe innovate in the payments industry and become a major player in online payments. Canva is a graphic design platform that received venture capital investment to develop its user-friendly design tools and expand its user base. The platform allows users to create professional quality graphics for various purposes, from social media posts to presentations. DoorDash is a food delivery platform that received significant venture capital funding to expand its operations and establish a presence in multiple markets. It has become one of the largest food delivery companies globally, connecting customers with local restaurants. Warby Parker Warby Parker is an eyewear retailer that disrupted the traditional eyewear industry by offering affordable, stylish glasses directly to consumers. Venture capital funding supported the company's growth and helped it become a popular brand in the eyewear market. Coinbase. Coinbase is a cryptocurrency exchange platform that received significant venture capital funding to develop its infrastructure and become a trusted platform for buying, selling, and storing cryptocurrencies. It played a pivotal role in the growth and adoption of cryptocurrencies. Beyond Meat. Beyond Meat is a plant-based meat substitute company that has received significant venture capital investment. It has disrupted the food industry by offering alternative protein options and catering to the growing demand for plant-based products. Peloton. Peloton is a fitness technology company known for its interactive exercise bikes and treadmills. Venture capital funding played a crucial role in the company's growth and helped establish it as a leader in the connected fitness industry. Robinhood. Robinhood is a popular commission-free stock trading platform that gained significant attention and venture capital funding for its innovative approach to democratizing access to financial markets.